We like to think of the global economy as a perfect, self-healing machine, a complex engine of supply and demand that, if left alone, will naturally find its way back to perfect balance. But history tells a different, much darker story. From the Great Depression to the 2008 financial crisis, we've seen that when the economic engine stalls, it doesn't always restart. Sometimes it just stays broken. Welcome back. Today, we are going to explore a radical theory that changes everything we know about wealth, unemployment, and the invisible force that actually controls your financial future. For decades, mainstream economics has been split into two warring camps. On one side, you have the classical view. They believe markets are perfectly efficient. If there is unemployment, wages will simply fall until everyone is hired back. On the other side, the Keynesian view argues that markets can panic and get stuck, requiring the government to step in with massive spending to save the day. But what if both sides are missing the most crucial piece of the puzzle? What if the economy isn't a physical machine at all, but a reflection of our collective psychology? To understand this, we have to look at something scientists call multiple equilibria. It sounds complicated, but the concept is terrifyingly simple. Imagine a bowl with a marble in it. In traditional economics, there is only one resting place for the marble, the very bottom of the bowl. This represents full employment. Push the marble, and it always rolls back to the bottom. Imagine a bowl with a marble in it. In traditional economics, there is only one resting place for the marble, the very bottom of the bowl. This represents full employment. Push the marble, and it always rolls back to the bottom. And here is the groundbreaking truth. The marble can stay perfectly still in this new dip. The economy has found a new normal. But this normal is characterized by massive unemployment. It will not fix itself. So, what determines which dip the economy gets stuck in? In a word, confidence, or as Wall Street calls it, animal spirits. The wealth of a nation isn't just in its factories or gold reserves. It is priced into the stock market. It lives in our collective belief about the future. And when that belief shatters, reality shatters with it. The wealth of a nation isn't just in its factories or gold reserves. It is priced into the stock market. It lives in our collective belief about the future. And when that belief shatters, reality shatters with it. When the market is booming, everyday people feel wealthier, even if they haven't sold a single share. Their retirement funds look healthy. Because they feel rich, they buy new cars, go on vacations, and take out mortgages. Businesses see this surge in demand, so they build new factories and hire more workers. The belief in a strong economy literally brings that strong economy into existence. We settle comfortably into a good, full employment equilibrium. But then, a panic hits. It could be a banking crisis, a pandemic, or a housing bubble bursting. The market plummets. Trillions of dollars of wealth vanish into thin air in a matter of days. People look at their depleted accounts and freeze. They cancel vacations. They delay buying cars. Businesses instantly lose revenue, so they stop expanding and lay off workers. The fear becomes a brutal, self-fulfilling prophecy. We are now trapped in a bad equilibrium. Traditional solutions tell the central bank to lower interest rates to zero or print money. But this is like pushing on a string. If everyone is terrified of the future, cheap credit won't make them spend. So, what is the radical solution? If extreme swings in asset wealth are what drive the economy into these traps of high unemployment, we must neutralize those swings at the source. The proposal is incredibly bold. Central banks should stop obsessing solely over inflation and interest rates and start directly targeting the stock market to maintain stable wealth growth. Imagine if the central bank created a publicly traded index fund encompassing the entire market. By actively buying and selling this fund, they could control the price path of the stock market, ensuring it grows at a steady, predictable rate. When irrational exuberance creates a dangerous bubble, the central bank sells its shares, cooling the market down. When blind panic causes a crash, the central bank steps in with its infinite balance sheet and buys, placing an unbreakable floor under the market. Critics will scream that this is market manipulation, but the central bank wouldn't pick individual winners or losers. It would only trade a broad, market-wide index. By eliminating violent crashes, you protect the wealth of the population. By protecting their wealth, you stabilize their confidence. And stable confidence guarantees consistent consumer spending. Ultimately, this keeps our metaphorical marble permanently resting in the dip of full employment. The economy is not a machine independent of us. It is our collective psychology. Master the panic, and we might just conquer unemployment forever. Thanks for watching.